here we are, beautiful Lake Tahoe, at the Edgewood Resort, at a wonderful private event put on by the Collective. I think this is maybe my first time recording an outdoor podcast. How about you?
Definitely a first for me.
Well, I think the first is quite an eventful first. I mean, I don't think we're ever going to do anything better than this.
No, it's a pretty high bar.
So we're both Northern Californians, so we were able to drive up here. So both of us have been here many times. And when I look behind us, obviously it's the grand natural resources of California, right?
Yep.
And we're here also to talk about the other natural resources. But I was also telling PJ yesterday at the event how what I love about California is like the cosmic insignificance meditation, right? This place is so grand. It makes me feel so insignificant.
Yeah.
But you've lived here your whole life. Did you take it for granted sometimes, or you still see all that natural beauty?
You know, you do have to catch yourself every once in a while. I've been coming up to Tahoe since I was, 3 or 4 years old, and my family had a place up here for 20 years. And so, there are times when you're a younger person where you definitely start to take it for granted. But I think there are always moments where, you have the quiet and you have the calm, and you look out on something like that and you understand, why this was considered such a spiritual place by, the original Indians that inhabited it. It's a very grounding place. I've always really enjoyed it up here.
And then for those that don't know, my pleasure today is my illustrious guest is my friend Robert Mullin from Marathon Resource Advisors in San Francisco. So maybe, Robert, we could start with you giving a brief bio or in your own words of how you got here.
Sure. So I've been a natural resource investor since the early 1990s. Went to school in another beautiful place, the University of Colorado at Boulder. Clearly I like the mountains. And skiing and everything that goes along with it. But I started out in the natural resource space at the Franklin Templeton Group. Covered a couple of sectors before that, but really gravitated towards resources. I had a little bit of a family history in that. My mom grew up on a West Texas cattle ranch where, unfortunately, they looked for oil and natural gas. They never found it. So it was about as far from Dallas as you could imagine. Very unglamorous, but a wonderful place to, really understand the outdoors and sort of rural Texas. And so, came out of the University of Colorado, backpacked around the world for a year, and then started working for Franklin Templeton. And the energy sector was always one that seemed like an easy fit for me. It fit with my natural skill set, which was I've always been less of sort of a fortune teller about sort of what future multiples might be on certain sectors or certain companies. It's really about trying to buy a dollar's worth of assets for significantly less than a dollar, and it's very mechanical in some ways and very, mathematical, and you build models and you understand cash flows and you understand assets and so that's how I got started in it. And so, and been doing it ever since. So now it's pretty much 30 years of banging my way around the natural resource space.
And then you said 30 years, so also you probably won't mind me dating you a little bit, but I had to go back to backpacking around the world for a year.
Yeah.
What year?
So that was 1991, 1992.
This is so perfect because I remember the very first time I got an email address was 99 in Istanbul, Turkey. I signed up in an internet cafe for like a Hotmail account.
Yeah.
So what you and I both know is like when you're traveling around the world in the early 90s, it's a totally different world, right?
Absolutely.
No cell phones, no email, no anything. It's a totally different world.
No, my parents wanted me to check in like every Sunday, so I would try and find a place where I could make an international call, which is easy from Europe, but significantly harder from areas like Thailand or mainland China, which we went for a little while. We actually thought about doing the Trans-Siberian Railway. But unfortunately, there was a coup around that time, so it was it got a little messy. But it was an amazing experience, and it was navigating around the world back then. Pardon the pun, but demanded a resourcefulness to be able to figure out where you were staying. There wasn't an internet to figure out where you would go. You couldn't email back and forth with these people. Oftentimes, the language barrier was pretty significant because in some places English was very frequently spoken, other places not so much. So it really took effort to travel, and there was a reward that came with that, which was pretty amazing.
I was thinking about now that I'm an adult, my poor parents, like I would call home once a month for like 5 minutes,
Yeah.
I'm doing fine, I'm alive, and that's all they knew about it was going on. And then so I think about too, I'm always very romantic about the natural resource space, and I think about the miners that are flying all around the world to these far-flung places, like going into these countries, figuring things out. And then so part of that romanticism is Jim Rogers. And Jim Rogers wrote, those great books about riding his motorcycle around the world.
Investment
So is that,
Bank, yeah.
how much is that like tied in? Like, how do you think about that? As like that, probably that backpacking trip, not knowing at the time, sows kind of those seeds where when you're dealing with natural resources, you're dealing with these global commodities. And it has a very, to me, very romanticism, very global traveler kind of sense to it.
There's something sort of basal and fundamental to them. You understand how everything works off of the raw materials, whether it be, energy or copper or agriculture, or it just nothing works without it. Nothing survives without it. So you get a taste of that. But it is also, there is without question a sort of adventurism, romanticism about it. It's like pirates and buried treasure. You are trying to go to the far reaches of the world to find something that before no one thought existed. And so there is an element. It's distinctly less sexy when you're camping out in the middle of the Northwest Territories, and and this was never me, to be clear, banging away at rocks for 6 or 7 years, and all of a sudden you're like, well, geez, we got nothing. But I think the air from the investor side and even the casual observer side is very much that there is some romanticism to it, absolutely.
And then everything now about like drilling technology and everything, do you still wish you guys had that West Texas ranch? Do you think there's actually, does part of you think with the technology there might have actually been something there, they just missed it?
Yeah, so the ranch still is in the family.
Oh, really?
Yeah, so I'm the oldest of 13 cousins who are still involved with the ranch. It's, we're pretty sure that I think natural gas would probably have to go to something very, very high to make whatever is on the ranch economic. It's in a period. It's sort of it's called the Marfa Basin, so it's not too far away from a very cool artsy town where I actually have family in Marfa, Texas, and so look, at some point, if natural gas trades for $20 an M, we might have a story there. Between now and then, we actually, one of the things that we thought about was when the frac sand boom was going on, where people were looking for the materials to push down into the reservoirs to be able to hold open the cracks in the very highly pressurized reservoirs. We thought we might have a deposit of frac sand on the ranch, and unfortunately that boom kind of crested and rolled over a little bit too quickly for us to take advantage of it.
Timing gets us every time.
Without question. Yep.
So one of the things that's been obviously highly prevalent these days, but you've been writing about for years, and I always love reading everything you write about and watching all the videos you do and all the talks you give, is this transition to EVs. And whether that battery transition looks like with, traditional raw materials, but also to rare earths, all that sort of thing. Yeah. So talk to me a little bit about how you think about that transition to EVs and how that affects the way you think about trading the markets.
Yeah. So there's a political imperative to move this way. The decarbonization, kind of flip side of that is anti-fossil fuels, but there's an extraordinary global imperative to move towards more EVs. That's seen as sort of the tip of the spear of decarbonization and reducing CO2 emissions. I think there are nuances to it that are lost in most of the political discussion. But without question, I think the stats, someone like Robert Friedland from Ivanhoe will tell you that we need more copper in the next 20 years than we've mined in the last 200. So it's a huge call, whether it's the batteries for the EVs themselves, the other materials that are necessary to be able to make EVs work, all of the transmission mechanisms, and all the infrastructure that goes around it, the grid-level battery storage that you need to turn wind and solar power into something closer to baseload, so it effectively can be integrated into the grid. All of that is massively materials intensive. For the same kilowatt hours of energy, relative to a natural gas or a coal plant, you need about 7 to 15 times more materials, metals and materials, to be able to generate that same kilowatt of energy via wind or solar. And so I think we've seen this as this easy, wind is free and the sun is free, and this is all going to be very easy, and all of just subtract that sort of side of the ledger that is the emissions generated by the oil and gas industry, and we're off and it's free and easy. the energy transition comes with a gigantic materials and therefore a energy and carbon footprint along with it to make it happen. And so it is both a challenge and a really neat opportunity. I mean, one of the things we were talking about in one of the sessions yesterday was, AI and how do you express it? And so this is a little less energy transition, but more that, you look at almost everything is materials intensive in one way or another. So, NVIDIA trades at, depending on your estimates, 35 to 40 times sales. You don't have to believe that NVIDIA wins. If you believe AI is a big thing, clearly the proliferation of significant numbers of microchips and microprocessors is going to be a key theme of that. NVIDIA may be the winner in that, they may not. The one thing you need for all of those is tin. Because 50% of the global tin market goes into microchips to be able to effectively solder them together. There are alternatives for it, but no one's using lead anymore for anything. That's that's even more toxic than most of the hydrocarbons. So one can't win without the other. One you can pay 40 times sales for. The others you can pay 4 times earnings for. And so, to me, I think there's just a much more interesting way to express it. The consensus around the room was, that's the way to invest in it, as opposed to trade it. And will people ever care? We don't know. But to me, that's just a much more comfortable way of allocating capital.
It's interesting to me in the sense that when you're dealing with commodities, right, it's almost like a throwback to bygone era, which is part of the romanticism. And then when you think about cash flows and being a value investor, it's a very staid way of looking at the market, a very smart way of looking at the market. But at the same time, when we're talking about EVs, we're talking about the future of batteries.
Yeah.
So you have this bifurcation of, right, you're thinking about old school commodity and digging stuff out of the earth and what does the cash flows of the company look like? And then people are promising all these future things with batteries.
Yeah.
And so I wonder how do you deal with that? Some of that dichotomy is like right now the batteries in the EVs are, they obviously become more and more impressive. Yeah. Like you're saying, for solar and wind, we have transmission, we need better batteries. People talk about even using batteries on planes.
Yeah.
So how much do you want to believe in this future battery, but sometimes you're like, the physics just doesn't pan out. And so it's hard to deal with sometimes.
Yeah, so you're replacing, when you build an EV, you're replacing 180 pounds of a gas tank with 1,000 or 1,200 pounds of a battery, which is massive. It's lithium, it is copper, it is manganese, it is graphite, it is all those things. Because of the weight of that battery, you need to do other things to the car, which is you need to make lighter panels. So you need more plastics. Guess what? More hydrocarbons. You need to replace steel with aluminum. Guess what? Huge energy intensity on that. And you have to actually get the aluminum. You got to get the bauxite. The torque generated, the weight and the torque of the EV actually goes through rubber tires much faster. So you're all of a sudden going through much more of a carbon footprint on the tires themselves. And so I think it is viewed in black and white. I can sometimes be absolutely insufferable at San Francisco cocktail parties when people decide to go off on a tangent, and I try to inject some of the real math to it. Occasionally I just get the tap on my shoulder from my wife just saying, all right, I think they come on. But it's true, and the real unfortunate truth is that most of the political discussion about the integration of renewable energy and EVs is done on effectively kind of cocktail napkin math. It bears no relation to can we find all the stuff that we need to build these as fast as we're promising, which I think the answer is no. B, can we get the infrastructure there fast enough to be able to make all of this work together in a way that gives us power on a reliable basis and allows our economy to to at least stay where it is, if not grow. And then, finally, there's I think this massive misconception about the actual cost of it, both in terms of dollars and in terms of carbon emissions itself. And so I just think that gets lost in the discussion, and all we get is snippets of politicians competing with each other as to who can promise the transition faster. Because look, polls great, and people love it. They're just not being told how much it actually costs. People here, well, we're actually in Nevada, but in the great state of California, we've seen exactly what it costs, where we've been the most aggressive in terms of integrating renewable power into our grid, and our power costs are going up 4 times as fast as anywhere else in the rest of the country. And Germany is having the same thing. And so I'd like the discussion to be more honest and more thorough. And unfortunately, that's just not the nature of politics.
there's a couple of divergences I want to take there. One, I think you were bring up yesterday too, like how many even hydrocarbons are in asphalt. Like so when for the roads and then correct me if I'm wrong. I think even in the rubber tires you need carbon black, which is a hydrocarbon as well, right? Yeah. But this is a totally outside the box question. But like sometimes you read about reflective natures of road surfaces and everything, and a lot of scientists or people will speculate that we should have like white roads and everything. Like, do you think we could eventually change that? Like, I was thinking, like, do they need to change tires? Is there a reason like we go with black everything?
Yeah, I think there are a lot of things that work, at bench scale. Yeah. That are really hard to implement on, at real scale. Yeah. So there was actually someone built a solar road in I think it lasted about 6 weeks before the pressure of the cars and the dirt that was on it and everything else just totally the degradation of productivity was really rapid, and the cost of it, I think they abandoned it after less than 6 months, and so I think what we have to believe is that most of the things that are getting integrated today have been in the works for a really long time. These transitions take decades, if not more. And the idea that we have that we can look at sort of the evolution of microchip technology and how fast do those things move, and do that to and extrapolate that to the physical world, where look, the first lithium-ion battery was created by a guy at Stanford who was on, a consultant for ExxonMobil in the late 1960s. And while the battery chemistry has changed, it's not significantly different. The electronics around it have evolved, yes, but I think the likelihood that we find a magic, hugely scalable kind of solution that really changes the economics of renewable power, and I think that's a stretch. The closest thing, quite frankly, that we have is nuclear, right. And we are, for reasons that are wholly political, choosing not to use that, which I think is one of the most remarkably short-sighted things that the world. I think we will look back at this in 30 or 40 years and say, if the goal is really to reduce CO2, why in the world are we shutting down existing nuclear facilities?
The other diversion I'll take, hopefully you'll disavow me of, because we brought up California, and you've been around for both Governor Browns, I assume, right? Or maybe you're a kid, with the first Governor Brown, but like I've always heard, and I never really dug too deep into it, so maybe you can tell me, is like the idea was originally with the original California Governor Brown, and even to his son, is like the idea with PG&E was like you didn't have to upgrade your infrastructure costs as much as long as they invested in renewables. So they gave them the incentive because they really wanted to push renewable energy. And so for decades now in California, instead of like upgrading their wires and their infrastructure, they put it all into renewables, and that's how they got away with not upgrading the infrastructure. Now that is easily like I jump to conclusions there, but do you think that's categorically true, or is it probably more nuanced?
It is more nuanced in what I understand. It's not an area that I am extremely well versed in, but I do think that the push to spend in areas that don't necessarily generate a near-term economic return has absolutely caused the starvation of capital to just the base level of maintenance. And we see that throughout the country, not just at PG&E. They are the most poignant example of that. But look, there's only a certain number of dollars out there. And if you are investing in things that don't currently generate economic returns, and I think one of the things we discussed in one of the sessions yesterday was, those who will tell you that the energy transition will pay for itself are relying on, I think, one of the most inane statistics out there, which is the Lazard levelized cost of energy, which is an interesting way to compare to some degree what, if normalizing what sort of the costs of different power sources are, but it bears absolutely no relation to the economic reality of installed power anywhere in the world. And so they'll point to these metrics and say solar is the cheapest way to generate power, and it's like, yes, if you don't have to pay for the land, and yes, if you don't have to figure out how to transmit it from one way to the other, and yes, if you don't have to store it someplace so you can use it at a period of time, and yes, if you don't need backup power from anywhere else just in case the sun stops shining, which it happens to do kind of half the day, and there are clouds, and it's there's a there's a shallowness of the arguments of economic viability. I'm fine with trying to make the environment better. I think this maniacal focus on CO2 is a little short-sighted. There are other things that we should be concerned about as well. But we have to have an honest discussion about what it's going to cost. I think people will be much less likely to give politicians a blank check to push renewables to a mass thing if they get the honest scoop, which is, well, guess what? Your power bills are going to go up by 30 or 50 or 100%. So let's just have that discussion, have it honestly. And if we're willing to pay for that, great. If we're not, if we'd rather pay for schools or roads or retirement for employees or whatever we need to do, then we have to prioritize.
One of my favorite things in life is one of those minor epiphanies or light bulb moment when somebody makes a statement of the obvious that you didn't think about before, and then you hear it and you're like, oh my God, that's so obvious. And one of the things you were really going into yesterday that was so brilliant, that to me was a statement of the obvious. I couldn't believe I hadn't really thought about it as much before, was the idea, like you were saying, is like any sort of natural resource extraction to go EV or however you're looking at it, the input costs of the energy and the cyclicality of this feedback loop of how much energy does it take to get these energy intensive resources out of the ground, and like the feedback loops of that. And like as these prices go up, the input costs go up. Yeah. And so maybe you could speak on kind of like that circular nature a little bit of like the cost structure.
So the energy transition has progressed as fast as it can, and renewables have grown as fast as they have because of, over the last decade, we've had very low cost of inputs. The raw materials and energy inputs have been very inexpensive. Production has been consistently moved to low-cost locales, a lot of it into China, where they get cheap labor and cheap power. And, quite frankly, a massive amount of government subsidies. And so, the spend on renewables has been something close to $10 trillion. Globally, a significant portion of that has been government funded. Very little of it has generated actual profits or economic return. I'm a believer that at some point, whether 10 trillion is that point or not, renewables have to sort of put on their big boy pants, kick off the training wheels, and show that they can generate economic returns. And we haven't got there yet. So the subsidies are still really significant. But then, absolutely, you look at this sort of cycle of, okay, in order to create the renewable systems that we need to do, we need to extract 20 times as much lithium. We need to, get as much copper in the next 20 years as we've gotten in the last 2,000. The problem with all of this that is lost in those who just look at sort of the U.S. Geologic Survey and say, yes, there's tons of copper out there, we can easily meet these needs, they miss the fact that there is copper in the earth, just like there's gold in the ocean. It's just not economic to extract. And so, look, we've had a big boom in the production of natural resources that was driven by the Chinese and Asian industrialization back in 2000 to kind of 2010. That capital expenditure boom extended out to 2014, and and we built a huge number of projects, and that led to the overcapacity that made resources such an awful place to be, effectively from 2010 to 2020. But now all of a sudden we're stuck with having to massively accelerate how much of these things that we need to produce for renewables, copper, lithium, nickel, zinc, all of the rare earth elements and things, at a time when the cupboard it's not bare, but there's a reason that the current projects that are in jurisdictions that we can do, that have gotten the permits that they need, that have had the delineation drilling that they need to really understand that deposit. The ones that are left are sort of, the way I described them yesterday was kind of an island of misfit toys. There are reasons that they haven't been developed yet. Because if they weren't developed in the last, from 2006 to kind of 2015, there was something wrong with them. Right? Because we had a really low cost of capital. Equity and debt were freely given to the resource companies because there was this belief of the extrapolation of this great commodity boom. So if it didn't get developed, it's because your grade is too low. You got to move too much dirt. It's too deep. It's too remote. And all of that, what that all boils down to is it's more energy intensive. That and the head grade, which is what the production grade of copper, 15 years ago was 1.3%. Now it's 0.7, I think. So the amount of dirt that you have to move from today's mines, the existing mines, not the new ones that we have to build, but the existing mines, you have to move twice as much dirt to get the same amount of copper. That is energy, to be able to move all that. And the idea that we can kind of go out into the, wilds of Chile, or the, or none of it up in, northern Canada, and then power that with renewables. Like, a big electric dump truck is going to have a battery about as big as the truck.
Yeah.
So it decreases the efficacy of it. And they're starting to get some of that technology forth. And in some places there may be ways to use it. But then you're talking about having to make the battery for that truck. So there's, the way I described it was a giant Ouroboros of
Yep.
the more you create renewable systems, the more energy and extraction and, quite frankly, CO2 production that will happen because of that. And so I just think we're looking at a very narrow part of the ledger without taking into account the secondary and tertiary effects of it.
My simplified analogy of it that I thought of too was like those first few seasons of Gold Rush, the TV show. Very romantic, love watching it. But all I could ever look at was the input costs. Is like the more tailings they move, like you said, like all the good land's been picked over, right? For in the Yukon, so they're going like into tailings, or they got to dig deeper, or whatever. And then every time they fire up all of their bulldozers or all of their dredge, everything they do is requiring that oil input cost. Yeah. So as long as oil remained low, they had that delta, and gold prices remained high. And there was just always this race. Like everybody look at that gold at the end of the week and being poured in. They go, oh my God, they made like $500,000 this week mining. Right. And then I'm waiting for the after of like, how much did they spend on gasoline? How much did they spend on labor? It's like running 3 shifts, like the amount of gasoline the inputs cost to that, and how they have to mine. It was kind of fascinating to me to think about the input costs. And the other one I thought of just now was thinking about, you have to have a rational perspective. I mean, it's good for people to be optimistic to push us forward, but then it made me think of Ica Batista in Brazil, right? Like deep ocean drilling off the coast of Brazil. Yeah. Great idea. Maybe the input costs were higher than he expected, and he lost his wealth faster than any billionaire in history. Yeah. So to give another example.
Yeah. Little less romantic version.
Yeah, that's
resources, right?
That's definitely the less romantic version. It's such a fascinating story. I was like living in Brazil at the time that all that stuff happened, so it was always fascinating to me. One of the other things, like we talked about all these different parts. You have a coordination problem, and you and I didn't have time to talk about this yesterday, but like when you're talking about especially movement to electric vehicles, batteries, renewables, there's a global coordination problem, and I think like historically. It always is kind of interesting to me that as first world countries, we tend to push our pollution, our refining, our toxic industries off into emerging markets, and then we tell them you need to upgrade to our standards, and then they're like, we're just industrializing our nation, and you push this pollution onto us, and so there's a tragedy of the commons problem. But the one that I thought was most interesting recently that I think I was talking to a guy with StockGen was talking about this was that when Germany. Was always hold the line, we're doing all this stuff. And then when all of a sudden their natural gas pipeline gets shut down and everything, all of a sudden they flipped on a dime. And so what does that tell to all the emerging markets? They're like, hey, you changed your mind and you switched. Who are you to tell us to do what you couldn't do?
Yeah. They went, they spent $500 billion to build out their renewable infrastructure, and built a very flawed and very vulnerable system. And then the moment that it looked like the lights might go out, they went straight back to lignite coal, which is like the bottom of the barrel, kind of dirtiest, nastiest stuff that you can imagine. And so, I think it's a great example of how challenging this is. It really is. It's just there's the struggles to be able to do that. The political imperatives have outrun the physical realities. Last year was a bit of a day of reckoning for that. I think we've slipped kind of back into a little bit of complacency about that. I look at, we have gone, if you think about what's happened in sort of Europe and the European power markets, we have gone from the equivalent of, like oil prices hitting $145 in 2007, right at the very front end of the global financial crisis, to the equivalent of the negative $45 print in COVID. You've actually got negative power prices in Europe right now because they swung so far. They spent, again, in addition to the $500 billion that Germany alone spent to go renewable, to go wind and solar, Europe as a whole spent $500 billion this winter just to make sure they had enough resources to be able. So they got a little bit of a hand from Mother Nature. So they had a 2 standard deviation, warmer than warmer than normal winter. And so, now they've got this surplus, and power prices have gone negative. And so everyone's like, hey, we're good. There's a problem. We're done with it. We're all, we're back. That's not the case. There were things about last year, not only just the weather variability that you can't count on having cooler summers and warmer winters in rapid succession like that. History shows you it just doesn't happen. But really, the reason that they were able to secure as much LNG as they did last year was that China was shut down. China was effectively out of the market. They were, importing, I think 30% less LNG. So that opened it up for Europe to go out and compete for it. China's no longer closed down. And so if we do, and certainly Nord Stream doesn't look like it's going to be working anytime soon. So there's a really interesting kind of opportunity set opening up, because we've gone from kind of maximum concern to total complacency again. And that's reflected in the equity markets for some of the European kind of natural gas producers. And so I think there's kind of an interesting, I think, very asymmetric bet that can be put on there that I think is kind of interesting.
So I want to come back to the asymmetric bet. I want to also come back to like global macro and how you think about that overlay and supply chains and dynamics with China and Belt and Road Initiative and those sorts of things. But I kind of come back to some basics a little bit. Is like when we think about natural resources, commodities, etc. I work with a lot of CTAs, and that's how people usually think about investing in those markets is via, future strategies. But part of it is a lot of people will say that, when they look at stocks, bonds, and then commodities, they're like, it's a neutral return environment. So people like to put a trend following overlay on it and trade directly in those futures markets. But I think a lot of times we were talking about yesterday that when we talk about rare earths or some kind of like off the run, so to speak, metals, et cetera, there's not liquid commodity futures markets for that. Like they're only spot markets. And so then it's maybe better to go into the resource equity markets like you do. And then that's where you can find companies that are working on this. But now you got another set of problems. We all have nuanced trade-offs, right? And now you have, a management problem. You also have that Keynesian beauty contest that we were talking about yesterday. With what's the market's voting machine, doing to that equity. So maybe talk to me about the nuances of why you prefer the natural resource equities than necessarily playing in the futures markets.
Yeah, and I will say I do some of the futures directly, and we put on some reasonably successful gold and silver direct commodity trades earlier this year. But really, the skill set that I think I've developed over the last 30 years is really in the resource equities. And so it's part about trade construction. It's part about understanding the different variables, and it differs at various points of the cycle. And sometimes it's better to do a commodity investment. But to me, I have always believed that if you really do your work in the, 300, 400, 500 kind of resource securities that I think kind of fit our criteria, which are high free cash flow generating, some sort of capital return and focus to them. And so we're naturally self-selecting a less volatile, less downside vulnerable sort of subset of resource equities. And so to the extent that we can find things that work in that realm, and you can really get comfortable with management risk and local geopolitical risk and the geologic risk of the specific deposit. And the more you invest in sort of later stage things and not taking exploration risk, the more you have kind of certainty about that. And so that's why we've typically I did a lot of early stage, pre-production exploration and early development stage investing earlier in my career. I'm just more comfortable when, we know what's underground and we know what the cash flow statement looks like. And so, sometimes it's hard. I have found at times where there might be a very specific niche commodity that I want to be involved with, and there just isn't a good equity way to express that. So then you sort of have to look for something else, and maybe, like Chris had a fantastic talk yesterday about sort of options theory and trade expression, and so then there are ways that you can find different ways to express it, and but for the most part, there's typically enough equity depth to be able to find what we want to do in at least modest size to be able to make it work in various markets. And so right now we're, very constructive in energy, which is usually pretty easy to express. There's lots of options there sort of globally, and it's probably half of the natural resource traded market is in energy. Agriculture is a little bit of a thinner market, but there's still a fair amount of volume in those names, and a lot of different options. Whether you want to be into fertilizers or plantation companies, or we've been involved with palm oil companies in Indonesia, and there are lots of different ways to get there. I think that's a very interesting space. We have had last year was a big year for us in the lithium space, and so we had some things that were a little bit earlier stage than we typically go, but it was just a really spectacular asset in a place where we thought we had a due diligence edge on it because of some of the people that we work with. And so, I think there's just a lot of very interesting things going on in the natural resource space. And there's no shortage of ideas. If anything, it's just a shortage of capital to be able to invest in all the things that we want to.
So one of the ways I think about resource equities too, I think a lot of people's first entree into resource equities is via gold, right? Like people start with gold and then they want a more leveraged version, so they go with the gold mining, equities, and you see people play that. But like they're searching for positive convexity, but a lot of people tend to get burned in that scenario because also they don't maybe do enough research or due diligence or expertise in the space. They're just looking for a leveraged gold play. So maybe talk to me then about like how you construct your book and how you think about it. Like when I think about your book, the three elements are like equities, yield, and options, even though those kind of blend together, but like kind of talk about like how you think about how do you achieve positive convexity in the natural resource space.
Yeah. So, let's start with the long book. So really the core criteria is significant free cash flow generation that is sustainable. So not just someone that's going to generate great cash flow for 3 or 4 years, but can do it for 10 or 15 or 20. Low cost structure, so they can survive the cyclical nature of these commodities. Hopefully coupled with a management team who's willing to give some significant portion of that income, free cash flow generation back to us. We like to see a combination of growth and capital return. So we're not just necessarily looking for stagnating or even liquidating entities. We like people who can grow assets over time as well. And so, we're willing to accept lower yields off of things like that have a growth element to them as well. And then it's really about spreading the book across the resource spectrum in a way that gives us sort of stability. And I think most resource funds are typically kind of mostly energy, maybe a little bit of copper. And so that tends to be a very GDP, economic growth sensitive kind of book. I like incorporating in areas like agriculture, which are a little less cyclical from a traditional growth sense. I like some of the processing industries or transportation industries, shipping and refineries and chemical producers and things like that. Gold has a tendency to be counter-cyclical, and so you don't see a lot of people who incorporate a decent gold book into a traditional energy and maybe base metal book. And so that's an area that I've always really liked. And then you delve into those pockets and you sort of say, all right, how big do I want that to be, and how should it fit into the overall structure? And then how do I construct it via the securities underneath it? And so I think the gold book right now is a really interesting example of that. I have a combination of kind of larger cap gold producers, again, very low cost, generating good dividend yields and good highly economic growth. And those are sort of a basket. I think our biggest position there is 7 or 8%, but I think our total precious metals books is over 40% on a gross basis of fund equity.
Do you run any like constraint bands when you think about sector weighting, or do you not worry about that?
I don't, and it's really it's just if it feels too big, then you've got to take it down, or if you can't find enough ways to express it, then just got to keep it smaller. So the way we've expressed the gold book is, so we've got some producers, we've got some royalty companies, and we also have a kind of a very interesting way to play that I've talked about publicly before, is a gold asset manager, where I think, you've got, I'll go ahead and name it, it's Sprott Inc. I used to work with John Hathaway at Tocqueville. He and Doug Groh and the rest of the team are great mutual fund managers. But Sprott has this really interesting combination of physical commodity ETFs, not just precious metals, but also uranium and other PGMs and things like that. And you look at this asset manager, and it was the same market cap, stock base was the same place today when they ran $8 billion in AUM, and then they went to $16 billion in AUM, and then they went to $20+ billion in AUM. It's in the same spot, and so in a world where I think people would prefer to play, if they're going to go into these dirty extractive industries, and they're going to have to make a strain on their ESG thing, give them the easiest thing to find that they can. And a gold asset manager is a very low bar. The royalty companies are very similar because they don't have they have relatively good ESG scores. And so what you've got is, if you're, my parallel for this is in the early 2000s, so the great gold market of kind of 2001 to 2007. There was a period in sort of the middle part of that bull market where, I think from 2004 to 2006, the GDX, or the predecessor to the GDX, was up 50 or 60%. So, good move over a couple of years. The one major gold asset manager, which was a company called US Global, was up tenfold. And it was because portfolio managers kind of found a way. They're like, all right, this market is getting underway. Gold asset managers can win in multiple ways, in that they get both the appreciation of the existing asset base as the sector rallies, but they also get inflows. So there's a reflexive element to it that can make them go from, say 20 or 30 billion under management to 100 billion under management. Then all of a sudden you sort of put a 5% of AUM multiple on that, and you've got a stock that can go up 5 or 6 times, where you're not taking geopolitical risk, you're not taking specific taxation risk or anything else from it, you're not taking specific asset risk where you have a wall cave in or something like that, or a tailings dam break. What you've got is just a very clean way to say, is this a sector that I think is going to work? Expressed in a way that can potentially be very asymmetric. In the interim, I'm just clipping a 4% dividend, and so I've got that positive carry with a convexity that's like, look, it looks to me like assets could fall by half, and the stock would really not go down much from here.
One of the other things you said yesterday that is one of those obvious things, but it takes a while to learn, and it's easier said than done, is the idea, like you said, you're finding these securities, you're doing your due diligence, you like cash flow, free cash flow, and that gives you that dividend yield. So there's your equity and your yield. But part of what you said too is if you structure the trade properly and you're comfortable with what they're doing, and you could create that positive convexity through that structuring, that now your position size need to be larger. And it's like the correlation between position size, conviction, or limiting or truncating the left tail to open you up to the right tail is like, now you found over the decades that you need to take larger positions than you previously would, based on like maybe it wouldn't be volatility, but you're figuring out a way to structure maybe lower volatility with positive asymmetry, or based on like kind of like a Sortino ratio effect.
It's really about the asymmetry.
Right.
What is my potential to look in when I was a 25 or 30-year-old hedge fund manager, I the biggest upside had the biggest position in the portfolio. Now it's more about upside relative to downside, and that's just part of getting kicked in the teeth a couple dozen times over the last 30 years. So then the next element of it is the short book. And so layered on top of that is areas where I try and isolate specific risks for the portfolio, whether it be in specific commodities. So if I've got a big energy book running, I'm going to look for ways that I can find a short energy position, whether that be through companies kind of destroying economic value, whether it be through, and this is true across the book, a lot of times I like companies that are destroying a clearly negative cash flow and will be perpetually. But I also like finding companies where, unsustainable dividend yields are being paid. And after 20 plus years of really understanding what's sustainable and what is not in the sector, when you find the unsustainable dividends, the asymmetry on the downside, when dividends have to be reduced or cut, are fantastic. And so, we've had something work this year in the wood pellet space that I thought was a little bit of a kind of a BS green story anyway. But there was a company involved with that was, paying double-digit dividend yield that was generating negative free cash flow. And so you knew it could not last forever. And when they finally did cut it, the stock was already down 50%. It fell another 70% that day. So that's where we try and create. So that's part of the short book, is directly within the kind of resource verticals we have. Sometimes it's more efficient to express, like, we're vulnerable to a negative turn in the economy. And so, whether you can express that well by shorting more cheap copper companies or steel companies or whatever, we do some of that when we can find situations where we think we've got an edge. But sometimes it's better expressed through other ways. We have a little bit of a consumer discretionary short book on right now. Also short a little bit in sort of subprime auto lenders and things like that, where that is the sort of the most vulnerable segment if we do have an economic slowdown, that people would say, oh no, we're going to be consuming less resources. Energy companies might not be the ones that, trading at 4 times cash flow and 10% dividend yields. They may not be the most vulnerable to that. The most vulnerable to that is kind of consumer, or some of these highly leveraged stocks that really require consumer spending and consumer health to remain very, very high. Look, if you think people are going to drive their cars less, maybe they just can't afford the car. So that's where I think there are some other things in our book that are a little bit tangential to what we do, and then the overlay on top of that. And when you mention the options, this is something that we've been doing for the last 4 years, is sort of a long volatility overlay in areas where we think we can find cheap expressions of volatility that correlate well with the vulnerabilities of the portfolio. Sometimes that can be, for a while we were sort of long dollar calls. The weird thing was last year, both long resource equities and long dollar calls actually worked. And so that's uncommon. But under normal circumstances, a spiking dollar is something that resource stocks are vulnerable to. Right now we own, some out of the money puts on the emerging market index, which is typically a group that trades pretty similarly to natural resource equities. And it's just cheaper than buying, puts on the oil service index, or, vol there is 3 times as high as it is in the EEM. There are some other places where, this is always an evolution, and as we have become a bigger fund, more instruments open up to us. And so 2 of the spaces that I think are very interesting for us to try to hedge with on a real macro basis are sort of the growth value rotation, which we have a tendency to be a little bit vulnerable to, because when growth is in favor and people are selling all their resource stocks, that's oftentimes either neutral or modestly positive for our short book. In other words, those stocks are going up instead of down, and our long book is suffering. But the other area that there are some interesting ways to potentially hedge in very highly convex ways is forward inflation expectations. So clearly, when inflation expectations are running high, and you go into something like the 5-year forwards market, and be able to hedge whatever might cause inflation expectations to come down rapidly, that's an interesting way for us to hedge our portfolio as well. And again, it's not a significant capital allocation for us at any given time. It's kind of 1 to 2% of fund equity. But when we get those things right, they can be very powerful counterweights to negative and shock environments for our long book. And one of the things that another thing that I talked about yesterday was resource stocks are never going to get this slow and steady up and to the right bull market like healthcare or technology, because the environment that makes resource stocks perform well, which is rising commodity prices, which is typically a component of rising inflation, that is inherently a very destabilizing force on the broader market, particularly a market that is priced for inflation never to be a sustainable entity ever again. And so that's something that we want to be cognizant of.
I also think about you get that amazing amount of positive asymmetry in options market when those correlation flips. Like you said, that if you're on the other side of that, and historically that correlation's been negative or flips to positive or vice versa, that's when you get some really explosiveness, because people are just basing it on a short-term look back. And if you can time those correlation changes, that's amazing. One of the other, I thought, brilliant questions that Chris Abdulmasih did ask you yesterday is and this is in relation to the China Belt and Road and global macro and how you think about that, is he said, do you just hedge out and neutralize your global macro risk so that way you can, really just look at them as idiosyncratic bets? Or so how do you think about that?
Yeah, and that's all part of what the short book and the option book do, is kind of addressing those current risks. And it's never going to be a clean dollar for dollar 100 delta kind of hedge. But if we can find ways where we can inexpensively express that, or so if I'm trying to neutralize my falling oil book or my long energy book from falling oil prices, I can express that either in puts or put spreads in the energy in oil specifically. I can do that via puts on energy and resource indices. I can do it via short individual equities. And clearly for us, the best is if we can find alpha alpha generating shorts at the same time that we can layer on top of a long book that we're very excited about, which is, kind of where we are today. That's the best of all worlds. And so it's just a matter of kind of looking at the entire, spectrum of ways to be able to try and say, take a step back and say, look, I have to have a macro view. But my macro view does not have to be correct. And more importantly, if my macro view is wrong, how much am I going to lose? And so, one of the other, there's so many wonderful things about this whole event, but, you talk to someone like Mike Green, who, is talking about some of the underlying sort of net distribution that's happening, and the potential for a little bit of index fund selling and things like that, a reversal of kind of the passive flows. And it perks up your ears about the need to really be thoughtful about, a risk of a kind of equity liquidation cycle is not something that I think there's much in the equity markets that's priced for right now. And there are probably some relatively inexpensive ways to express that. And so, again, that's another risk, that if you can find a way to throw 30 or 40 or 50 basis points at it, they can potentially give you a 10 or 15 or 20 to 1 kind of payout. Those are bets worth making.
So unfortunately, we're running up on time here, but we don't want to miss our sailboat on this beautiful lake behind us. But I thought a perfect place to end is because you teased it earlier, so I'll give the audience the morsels that it wants. You teased like some of the opportunities in Europe right now. Like, tell us about what you think is one of the more interesting trade ideas or interesting ideas you have, like that could potentially be implemented in Europe.
Yeah, so I'll speak about this at a high level, because I'm actually still constructing it myself and still kind of getting positioned for it. But what I spoke about earlier, which was we have swung from maximum concern to maximum complacency in the European power markets. And so you look at some of the natural gas producers in the North Sea and some of the related areas that really feed into the European energy system. And they had an unbelievable year last year. I mean, many of these companies generated their entire market caps in free cash. And what they did is they paid down debt, they started capital return programs, and now the stocks are kind of 50% off their highs. They're trading at, 2, 3, 4 times cash flow. You can construct a basket of these stocks with kind of different characteristics. So you're spreading around your risk of specific jurisdictions, specific assets, and things like that. And you can create kind of this interesting basket with a mid to high single-digit yield, kind of nice growth component to it. You're paying 2 or 3 times cash flow, and expectations for European power prices are in the gutter. And so, I look at that market and I love complacency intrigues me. Because these markets are self-correcting, and it's it beats you over the head time and time again. But when you're able to step into those, and stocks have gotten blown out and they're kind of basing around and they're not acting poorly on bad news or concerns about windfall taxes or anything like that, it kind of feels like this is an area to pick up cheap convexity. And so, and again, with the positive carry. And so you've got kind of a 6 to 9 month window where, look, maybe we get another super warm winter, and these stocks you clip your 6 or 7 or 8% dividend yield, and maybe these guys retire a little bit of stock, or and so fine, 6 to 8% in my worst case scenario, that's okay. But if we do get to a tight market, which I can actually see, because of the availability of LNG, because of sort of the turning on of some of the other European industries that were shut down last winter, now you get the opportunity set for, these stocks could double pretty easily. And so, we've got a portion of our energy book is allocated to that, and we're kind of in the process of growing that.
So you had some other really interesting ideas around like carbon sequestration. You had some amazing statistics around Petrobras. But for people that have those kind of ideas, they're going to have to come to the next collective event. We can't give away all the secret sauce. But I want to thank you for this conversation. I always love picking your brain about resources, and also want to give a huge shout out to Shannon and the collective for obviously giving us this beautiful place to have these intimate conversations where we don't have to worry about kind of the outside world, and we can all kind of banter back and forth, and iron sharpens iron. That's what I love about these, is like you have all kinds of experts in the room, and people will really push back, and collectively we hopefully find a better place.
Yeah.
So once again, thank you for coming on.
This has been fantastic, Jason, and such a wonderful event. And like I say, look, my previous travels this month were, I went to 2 different conferences, a mining conference and an agricultural conference. Met with 40 companies over the course of collectively like 6 or 7 days, and so that's part of the blocking and tackling of what I do. The harder part of what I do is creating the worldview and how to express it that enables me to be a better portfolio manager, not just the mechanics of the companies underlying it, but really how to construct a portfolio that's going to weather whatever the world looks like over the next 6 to 9 months. And that's why this sort of opportunity set is so unique, and it's been a lot of fun.